Have you ever wondered what actually happens the moment your pay lands in your bank account? Most Australians think their money just sits safely in the bank, waiting for them to spend it. But that's not how banking works. The truth is, the moment your salary hits your account, your bank starts putting that money to work. It helps fund home loans, business loans, car loans, and credit cards for other Australians. That's how banks keep the economy moving, and how they make billions of dollars every year. Today, I'll show you exactly how the Australian banking system really works, in simple English, with no confusing finance jargon. By the end of this video, you'll understand where your money goes, why interest rates change, why mortgage repayments keep moving, and how you can make smarter financial decisions. Let's start with the basics. Imagine you deposit $10,000 into your savings account. Most people picture that money sitting in a vault somewhere with their name on it. It doesn't. Banks combine your deposit with millions of other Australians' deposits and use that pool of money to lend to people buying homes, starting businesses, or financing cars. In return, borrowers pay interest on those loans. The bank then pays you a much smaller amount of interest on your savings. That difference is called the interest margin, and it's one of the biggest ways banks make money. Now you might be wondering, what if everyone wanted their money back at the same time? That's where Australia's banking system is different from what many people imagine. Banks are heavily regulated and must hold enough high-quality assets and cash to meet their obligations. They're also supervised by the Australian Prudential Regulation Authority, or APRA, whose job is to make sure banks remain financially strong and protect depositors. On top of that, eligible deposits with authorized banks are protected by the Australian government's financial claims scheme for up to $250,000 per account holder per authorized institution if a bank fails. That protection gives Australians confidence that their savings are secure. You've probably also noticed that home loan rates seem to change every few months. That's because of the Reserve Bank of Australia, or the RBA. The RBA sets the cash rate, which influences the interest rates banks charge and pay. When inflation rises too quickly, the RBA may increase the cash rate to slow spending across the economy. That usually means higher mortgage repayments, but also higher interest rates for many savings accounts. When the economy slows down, the RBA may reduce the cash rate to encourage borrowing and spending. So even if you never borrow money, RBA decisions can still affect your everyday finances. Australia's banking industry is dominated by the big four banks: Commonwealth Bank, Westpac, NAB, and ANZ. Together, they look after millions of customers and hold a large share of the country's deposits and home loans. While there are also regional banks, mutual banks, and credit unions, the Big Four continue to play the biggest role in Australia's financial system because of their size, technology, and nationwide networks. But here's something many Australians don't realize. Banks don't just make money from home loans. They also earn income from business lending, credit cards, personal loans, transaction fees, merchant services, foreign exchange, and wealth management products. That's why banks focus so much on attracting new customers and encouraging existing customers to use more of their services. The more financial products you use, the more opportunities the bank has to generate income. So how can you use the banking system to your advantage instead of letting it use you? First, don't leave large amounts of money sitting in an account, paying very little interest. Compare savings accounts regularly, because rates change often. Second, if you have a home loan, learn how an offset account works. For many Australians, an offset account can reduce the interest paid on a mortgage and potentially save thousands of dollars over the life of the loan. Third, review your banking fees. Many people are still paying account fees they no longer need to pay. Finally, compare banks from time to time. Loyalty doesn't always reward customers, and switching banks could lead to better interest rates, lower fees, or improved features. The biggest lesson is this: banks aren't your enemy, and they're not simply giant vaults holding your cash. They're businesses that keep money moving through the Australian economy. They help people buy homes, expand businesses, and invest in their future. Understanding how they work gives you a real advantage. Instead of simply accepting whatever your bank offers, you can make informed decisions that help your own money work harder. The Australian banking system may seem complicated at first, but once you understand the basics, it becomes much easier to see why interest rates change, why banks earn billions, and why your financial decisions matter. The people who build wealth aren't necessarily the ones earning the highest incomes. They're the ones who understand how money works and make it work for them. So the next time your salary lands in your account, remember this: your bank is already putting your money to work. The real question is, are you making your money